Would you bank your retirement on a strategy popularized when this kind of stuff was fashionable? Look at this. Outrageous. Well, that's the 60-40 portfolio, 60% stocks and 40% bonds. Listen, it had a great run since the 80s, but the world, that's a very different place today, and so are the needs of retirees. So could an 80-20 portfolio be the modern twist your nest egg needs? Let's find out. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to DIY investing with perspective from savvy investors and financial pros. Presented to you, as always, by TD Direct Investing. I'm your host, Rob Moise. We're dedicating the month of June to helping you get the most out of your retirement. And we're going to be tackling a contentious topic about investing for your golden years each week. Here's a sneak peek at what's on tap. You can watch on Webbroker, YouTube, and our broadcast platform, as always. And you can also get in on the conversation during our live Q&A sessions. There are plenty of ways to have your say, so don't miss your chance to have your burning questions about retirement answered. This time, we're getting a fresh take on the asset allocation that can help you reach your financial goals in retirement. Joining us is Veronika Popova, portfolio consultant at Vanguard. Veronika, welcome back to the show. It's wonderful to have you in studio.
Thanks for having me again.
We're talking retirement, but I got to ask you right off the top, did you have any of those terrible 80s fashions in your closet at some point?
You know what? They keep making a comeback, like the 60-40. So yeah, I definitely can say I've had some of the 80s fashion in my wardrobe at some point.
I'm trying to picture you with one of those like outrageously large perms. I think you could pull it off. I think it could work for you.
You know what? Probably. I probably don't want to see it, but I'm glad that you think it could work for me.
All right, well, next time maybe you'll rock one.
Yeah.
But in any case, we're talking retirement this time, and I think we should just start with the basics before we get into things. Just kind of give us a snapshot of what a retiree is essentially looking for out of their investment portfolio in their golden years.
Retirees are looking for, I think, what everybody's trying to look for. They're trying to accomplish it all. Not only are they trying to maintain their income and have some sort of money that is, giving them replacing the salary that they used to have. So they're trying to do that. They're trying to get an income. They're trying to do that while not losing any of their existing capital. So they're trying to not lose any money in the market either, which, as we know, is a very big challenge. The third thing is, while they don't want to lose any money, they want some for income. They also want to potentially pass some money down as well. So they also want to have money left over. They don't want to die with zero. So a lot of these three goals that retirees have and want to accomplish, that's, I think, what makes this so challenging and why planning for retirement, being in retirement, is probably one of the most difficult and challenging financial goals to plan for and to try to achieve, because these goals also conflict with one another. When you're trying to maintain your income, you're also pulling from capital, but at the same time, you don't want to run out of money. And by not running out of money, you typically would want to take a higher growth approach with more equities. So these goals all end up conflicting with each other, and I think that's, again, what makes this all so challenging.
Yeah, it can be a really difficult needle to thread, trying to balance all these things, like you say. 60-40 has sort of been the traditional approach that a lot of folks say is the one that's going to help them do that. But where might it fall short?
So to those goals that I was referring to, where it might fall short is for retirees that don't want to run out of money and have their outlive their assets, essentially. That is the biggest risk, and the reason why the 60-40 was once so popular was because retirement used to be maybe 10, 15 years. Now some retirees could live 40 years past their retirement date. And I think that's where the 60-40 does have a bit of shortfall, where having such a more conservative approach isn't going to help you reduce the risk of outliving your assets. Now, the reason the 60-40 did become so popular as well back then was bonds back in the 80s were benefiting from rates coming down. And bond yields were a lot more attractive. We're in a very different yield environment today with bonds. And that's where, to your reference of the 60-40 portfolio was invented during a different time. Would you do the same hair and the same outfits as was once, made popular in the 80s? Probably not. We're in a different world today, and you have to make some changes to adjust for that. So I think that's where the 60-40 could fall short for some retirees that want to ensure that they have some money left over even for their future heirs.
I can confidently say I could pull off none of those 80s fashions. So I certainly won't be reaching that far back into my closet. But in any case, so that's the sort of the challenge potentially with the 60-40. Why is 80-20 then potentially the solution to some of these problems that you've highlighted?
Well, it solves exactly the problems that the 60-40 falls short with, right? Having a higher equity exposure is allowing you to not just maintain your assets and have that income, but also grow your assets, which is what retirees should still be doing. Just because you turn 65 or 60 or 70, whatever age your actually retirement starts at, you don't just wake up one day at that age and get rid of all your risky assets and go into a fully conservative model. It's not the end of your investing journey, it's just another phase, another chapter. So that 80-20 might still work for a lot of retirees that do have that longer time horizon. Maybe they don't have a lot of health risks that are constraining their time horizon. And I will also preface by saying anytime anyone thinks about planning for retirement, even people that are farther away from retirement, the thought of what's your life expectancy is such a weird question and thought to have. But it is true where some people might have health risks and maybe that's a factor. Other people that have a longer time horizon, you still are accounting for maybe 30, 40 years post-retirement, and a 60-40 might not cut it. So you might have to shift into that higher equity portfolio that will allow your portfolio to not just provide you income, but also let it grow. And that other point I mentioned about having heirs and leaving a legacy for them, your retirement portfolio, if you account for how much income you have, and how much you need to survive, to do whatever hobbies and whatever interests you might have, travel, and you have this lump sum of money that's left over that you're not accounting for what you actually need. This is the money that you're planning to pass down to your heirs, grandchildren, children, nieces, nephews, whoever. They have a different risk tolerance and time horizon than you, right? So maybe at that point, you're not just thinking about your time horizon, you're thinking about theirs, because they might be able to have that higher risk tolerance. And if they're taking on your assets one day and they have that time horizon and that risk tolerance that can maintain that, then that should be considered as well in this whole debate that you're having, I guess.
Yeah, that's actually an interesting way to think about it. Like you almost compartmentalize some of the money that you're planning for, and yeah, it doesn't have to be like one catch-all solution with 80-20 versus 60-40. So what I'm hearing is that the need for higher expected returns due to longevity risk and stuff like that is a big factor. Bonds not being quite as attractive as they were when the 60-40 were invented. These are all real concerns. That said, I'm a visual learner. Right? I want to put some numbers behind this. So I was crunching some of the numbers because I think a lot of people might say, whoa, 80-20, like that sounds pretty aggressive for a retiree. But let's look at some of the numbers. We have an example scenario that we're going to walk through here. So let's say we have a 65-year-old. They're planning for a 30-year retirement. They've got $1 million split between $500K in the RRSP, $300K in the TFSA, and $200K in their non-registered account. And they're expecting about $21K per year from a combination of CPP and OAS, which is like fairly average, last I checked. Under these assumptions, the 60-40 portfolio was able to sustain roughly $65K in spending for 30 years, as long as you were pretty tax optimized with some of the withdrawals here. And you can see the different colors denoting when each of these accounts get depleted. The TFSA right there at the bottom is hanging on. But the 80-20 portfolio, when you look at the 80-20, it could sustain about $69K in spending for the 30 years, again, with a relatively tax optimized withdrawal approach. Veronika, what are your key takeaways from this study?
So I love the visual example. I think there's a lot of great tools like this online which really help visualize exactly what a difference in asset allocation can have. And we clearly can see that, what just making a small change in your asset allocation can have on your portfolio. It also brings up a very good point that I forgot to mention as to why 60-40 might not make sense for some people, is your investment portfolio is not everything. It's not all your assets, right? You also have CPP, OAS. A lot of retirees have also accumulated real estate over time. They have maybe some rental income that's contributing to their what they're receiving as income, right? So I love this example because it really does help visualize that, where your investment portfolio is in addition to the other parts of your assets. The other thing is that over this $1 million portfolio, an extra $4,000 might seem like a lot, might seem like a little. Everybody's different, everyone's portfolio size is different, but $4,000, that's a vacation. That could, pay for some restaurants. That allows you, one of the most important things I think in retirement is flexibility, not having to worry about outliving your assets, like I said. And I think that anxiety and stress is the biggest issue for retirees. You want to live comfortably in retirement. You don't want to have to worry all the time and not live the same life that you once did. You want to be able to retire and do all of that, right? So, yeah, great example. And I think obviously it's so many different assumptions could tie into it, but I think it paints the right picture of that's the difference in 80-20 versus 60-40.
Yeah, I think it's a good point. Obviously, you with any example, any case study, you play around with the numbers, you could get a different result. I tried to be as emblematic as I could. That said, if you look at both of those examples, we're effectively dying with zero here, right? We're just making it there, and as your earlier point, you pointed out, a lot of people are not comfortable with that. So let's take a look then. If somebody doesn't want to die with zero, they want to leave a legacy to their heirs. Let's say the retiree follows something like the 4% rule, okay? And they're spending $40,000 per year. In the first year, they adjust for inflation each year. Using those same assumptions that we were talking about in the prior case study, the 60-40 portfolio, get this, would actually grow to $1.4 million roughly by age 95. That's a pretty sweet haul. But get this, the 80-20 portfolio would grow to $1.8 million by age 95. That's an extra $400,000. Again, Veronika, your key takeaways from this.
This, obviously the difference between 1.8 and 1.4, a lot more meaningful difference. That extra 400,000, that could be you helping your grandchildren or children with down payments, paying for schooling, paying for cars. Like, that is a very meaningful difference just by shifting your allocation from 60-40 to 80-20. And mind you, with taking on that additional equity risk, with seeing these numbers, the thought is even, okay, so why don't I just go all in on equities, right? I think the key here is that there is still that 20% in fixed income. We're not saying, just still stay completely aggressive. You are retired, there is a bit less of a risk tolerance, but from going from a 60-40 and 80-20, you're still mitigating some of that risk, but the reward is that much greater, especially if your goal is passing down a legacy to your heirs, making sure you're not dying with zero, and just being able to live comfortably. I think that's some of the key things. One more point actually about that 4% rule, because I know that's a great rule of thumb. I'm not a big fan of rule of thumbs. I think they're a great benchmark, a starting point, but I think when it comes to your money and your money, it's one of the most important things that are dictating how you're living and all that. That's where you have to be a little bit more personal. There's never a one-size-fits-all option. Vanguard actually does recommend a dynamic spending strategy. So we say to adjust each year based on market conditions, your own spending. Some years you might be spending more than others. And I know with a dynamic spending strategy, you're able to actually adjust for that. So if the market did really well, maybe you can afford to withdraw a little bit more. Maybe if the market didn't do so well, you're able to pull back a bit so that you're not withdrawing during down periods, which can, as you know, affect your longer term compounding of returns. So yeah, I just wanted to mention that because I think that's also a great approach and a great strategy that many retirees can take, where you find the baseline that you really need for food, shelter, that kind of stuff to survive, medical. And then from there, you can adjust higher and lower depending on what's going on in your portfolio and in the world.
Yeah, certainly like 4%, like you say, a good starting point. But I find very few people, at least in my experience, actually follow it to a T, right?
Yeah.
Everybody's kind of varying things a little bit. That said, we look on paper, 80-20 portfolio looking pretty good here. That said, it's not for everybody. There are risks to consider. So tell us about some of those risks that you would need to keep in mind before you run to make the switch here.
For sure. So with the 80-20, as we know, you're moving to a more equity portfolio. And with that, you will see a bit more volatility. You will see a bit more swings. So you have to be comfortable with that volatility. And it's not like okay, I'm good with this, the 80-20. Market comes down, you go, oh, wait, no, this is too much for me. I'm going to sell it all and go to cash. That would be a great disservice to yourself to do that, because you've just prevented yourself from regaining those losses and making that money back and more in the future, right? So that is very important, is being able to stick with it, understand the risk that there will be some moves in the market. And as long as you're able to maintain those changes in the market, if you're not fully relying on your investment portfolio, then it's okay. If you have that CPP, OAS, workplace pension, that's another big one that's going to contribute. And your investment portfolio is kind of where the goal really there is to grow that capital. I think that's where the risks or the benefits will outweigh the risks. And even with that 80-20, you're able to adjust it to reduce some of that risks and diversify a little bit. So your 80% is not in the couple stocks that are high growth, tech, high valuation kind of companies. You're also diversifying to bring down that risk even within the equities.
Yeah, I mean, I wanted to just really get you to outline for us, what are some of the questions that you would need to ask yourself as a retiree for you to know this could be right for me, this could not be right for me. What are some of those key things you need to consider?
Definitely adding up all the sources of income that you have. So CPP, OAS, workplace pension, retirement, rental income, anything like that where you're receiving money. Are you previously an owner of a company or something that you still have dividends that you're receiving every year? Anything. That is all going to come into your list of where your income's coming from. Then you're going to calculate all your expenses and see the difference. Do I need to make up some of that with some yields from my investment portfolio? Or am I covered? Because then at that point, that's what allows you to take on some more risk. So essentially by doing this, you're assessing your risk tolerance. How comfortable am I with risk? Even if it all makes sense on paper, but you're the kind of person that you have a lot of anxiety and stress and you're checking every day and it's really bothering you, it's keeping you up at night, then you know what? It really might not be for you, because we also don't want people to be stressing out like that over their investment portfolio. The other thing is, I know it's a very weird question. What's your life expectancy, right? Do you have health concerns that is maybe shortening that, or have historically people in your family have had longer life expectancies? It's a weird question, but it's very real. And even to plan for your retirement to die with zero, that would assume that you're timing your life down to the year and to the day. So you're kind of combining all this to really assess, can I take more risk in my investment portfolio? And if so, then that's when you can shift your asset allocation. And that also might change on a yearly basis, right? That's not you turn 65, you retired, you made that decision, that's it. That's your plan for the rest of your life. It will change by asking those same exact questions over time.
It sounds like a lot of the crux of that is around, what is your floor, basically, amount of money that you need, the least amount you want? Because if you have flexibility to cut your spending based on how the market does, then yeah, sure, maybe you could take more risk. But if you can't, you need a certain amount of income, then I guess you have to lean more towards the certainty that something like a 60-40 might provide. Is that kind of like a fair characterization?
Yeah, exactly. And if you have a longer time horizon, that's also where you're able to take some more equity risk as well, because your goal isn't just the income. Your goal is also to maintain your assets and grow your assets. It's still a goal for you, right? You don't want to die with zero. You want to leave a legacy. That's also going to contribute to your how much equity you're having in your portfolio.
Okay, so you may have intrigued some retirees here with this 80-20 portfolio potential, but that said, I can see a lot of people saying, volatility, risk, like I don't want to be taking too much of it. We often hear that diversification is like the only free lunch in investing. How diversified would an 80-20 portfolio need to be to sort of help counter or at least mitigate some of the volatility risk there?
I don't know if we can quantify exactly how diversified you could be, but I think being diversified, like you said, it's almost one of the only free lunches out there in investing, and being able to diversify not just out of the US, but also outside of Canada. I know a lot of investors, retirees, they are loaded up on the Canadian banks. That is, it could get pretty risky because they all kind of move in tandem together, right? So diversifying even outside of Canada, diversifying outside of the US. I know Mag 7's super popular and the gains are very attractive, and I know it's tough to pull away from them and you have that FOMO. So just being able to diversify not just regionally, but also sectors, not being fully in financials or tech. Diversifying internationally is a great strategy. The other thing that you could do is focus on companies that are value, low volatility, higher quality. Dividend payers are a great way to do that and to diversify while also giving yourself a little bit of yield. So all of that together is what's going to diversify, because when one is moving up, the other is moving in a different direction, and that balance is what's going to keep retirees in the market without seeing everything drop at once, getting scared, selling it all, and then you really kind of, shot yourself in the foot at that point.
Yeah, we're emotional creatures.
Yeah.
It's easy to say on paper, I can tolerate risk, and then it slaps you in the face, and then all of a sudden you might be feeling a little bit differently.
Exactly.
Appreciate the perspective, Veronika. This is really interesting. I think some good food for thought for retirees who might be wondering, like, what are my options out here? And I think a lot of people might get, locked into the idea that 60-40 is the way to go, but it doesn't necessarily have to be that way. So some stuff to consider. We got a lot more to get to, folks, including our live Q&A that's coming up in just a few minutes. But if you're enjoying the show so far, you're finding it informative, it's giving you that food for thought for your own retirement, make sure you check out TD Direct Investing on our socials. We got QR codes on screen for all of the places you can find us for a ton of content designed to help level up your investing knowledge. Like I say, the live Q&A, it's coming up in just a few minutes, so get your questions in if you haven't already. First, though, let's bring in my colleague, Caitlin Cormier, because she's going to show us a couple tools in WebBroker that can help retirees manage their portfolio. Caitlin, welcome to the program. Great to see you as always. Let's get into it. The first tool you have for us is the asset allocation tool. So tell us, how can this help retirees stick to their desired asset mix, whatever it is?
Talking about the different mixes of portfolios here, obviously we talk about the percentage of stock versus the percentage of fixed income in your portfolio. Obviously really important to know where you stand. And also talking about diversification, where you're invested, which location. So I have a quick snapshot here of what this asset allocation tool looks like in WebBroker. So essentially what it does is, first of all, we'll see a quick little snapshot that will show you not only, how much of your portfolio is in equities versus fixed income, it'll also break it down more specifically as to where, so Canadian, US, international. And then as we kind of scroll down the page a little bit more, we will see, in fact, that you'll see the individual companies here that actually fall into these categories. So you'd be able to kind of click the button there and have those expand. It'll show you which different securities fall into each category, including ETFs. If you have an ETF that has, Canadian and US equities in it, it will actually show between the two portfolios. And this can also be really helpful when you're doing any sort of rebalancing. So if you see, all of a sudden your equities are at 85% and you want to bring yourself back in line, or potentially the opposite, this is sort of a quick, easy way to not have to do the math yourself, have it done for you, and be able to see where you can move funds around to get back in line with your asset allocation.
Anything that prevents me from having to do even a little bit of math sounds good to me. So that's a great thing to highlight. Let's get to your second tool, though. This is the projected income tool. How can this help retirees manage their spending?
Rob, great news. This is another way that you can save doing the math for yourself. Again, this is something you could calculate yourself, but it's really nice to have it done for you. This tool that I have on my screen now is projected income. As you said, it is a forward-looking projection as to what distributions you can expect in your account for the next 12 months. So that includes dividends from, again, ETFs or stocks. If you have fixed income products, that'll include the interest. So you can see there's a quick visual representation of when you will receive these distributions, which months, as well as how much money. You can do it on like an all registered account, or you can do it on a per account basis. And then again, as you scroll down a little bit further, you will see the individual securities within your portfolio, how many units you own, and then when you can expect and how much of a dividend you can expect from each one. And with this, always you need to keep in mind, of course, if you're doing like drip dividend reinvestment and you might be purchasing more securities, it's not going to give you a complete picture of exactly what will happen, even if there's dividend changes like increases, but it'll at least give you a bit of an idea how much income you can predict, and then that'll also help you with when you're taking money out. You'll know how much cash is already going to be available to withdraw and when.
Yeah, so certainly knowing how much income you can expect can help you adjust the asset allocation as you need to, like we were talking about earlier. So great, handy tool to have. Appreciate you showing us that, Caitlin. As always, that was TD Direct Investing Senior Client Education Instructor, Caitlin Cormier. All right, let's get to the floor now. Open up the question period for our viewers. You ready to get into it, Veronika?
Ready as I'll ever be.
Okay, I'm sensing some apprehension, but let's see what's up. Yog has a question for us, so let's get to that question. Many people are asking this. If I have a defined benefit pension, can it be considered the fixed income portion of my overall portfolio and allow me a 100% equity allocation? And if so, what factors should I consider before taking that approach? So what do you think about that idea, Veronika?
So, yes, but with caution. So again, I think it comes down to how much dollar-wise you need to survive. Housing, food, all that, calculating how much money you actually need, and does your workplace pension, is that amount that is being paid to you covering that? So I think very similar to my my answer earlier about adding up all the CPP, OAS, and all of that. To answer kind of the second part, can my investment portfolio then be in 100% equity? Again, yes, but with caution, right? That doesn't mean you can go and, you can, but would I recommend it? No. To fully be in high growth, maybe all technology stocks and only a handful of stocks, probably not. You might also still want to be a little bit more thoughtful with your equities as well, your stocks. Maybe focus on some companies, sectors, ETFs that are going to diversify. So even though you do have enough, covering from all different other sources, still be mindful with your investment portfolio, because at the end of the day, you're still retired. You don't want to have the stress of a super volatile portfolio, and you still want to have those assets grow over time.
Mm-hmm. Yeah, great perspective, because I think a lot of people might look at it like mathematically, like, wow, if stocks give me the best long-term return, why wouldn't I do that, right? But it's how much money you need right now, and to be able to survive that volatility that's going to come, right? Let's get to our next question. This one is coming to us from Clyde. Instead of holding 20% in bonds, what are the pros and cons of using cash or gold for that allocation? So some alternative assets here, and you can throw others in the mix too, like private equity, private credit, all that stuff. What do you think about that idea, swapping out some bonds for alternates?
So cash and gold, two different answers there. So cash, I will say the risk is that inflation, right? That your cash isn't moving along with inflation. And you want to have something that is providing you with a greater yield than that, at least. It could be something a lot safer, like a short-term bond that kind of is like cash, but is paying a lot more of an attractive yield. The other part of that question was gold or any other alternatives. The problem with gold is, yes, it's a diversifier, but it's still could be volatile, and it still is not consistent. Yes, it's had a great run-up. But now at this point, it's almost like a momentum play. And that in itself is a risk. It's a diversifier in the sense that it moves different from the equity and the fixed income markets during some periods. But would you actually want that if equities are doing well and gold's now having a bit of a pullback? that's a risk in itself, right? And I know you asked about other alternatives. Alternatives are such a big bucket. I mean, you have your commodities like gold, silver, whatever. They all move in their own ways as well. When we talk about privates and alternatives from that perspective, there's three actually, why it might be a little tough for retirees. One is the cost. Some of them are pretty expensive. Second is transparency. Maybe you're not as familiar with what they're holding, what it's doing, and sometimes the returns aren't that attractive, so that itself could be a risk. The third reason, and I think this is the biggest one for retirees, is sometimes they're not as liquid, so it's not recommended to be drawing on them during down years, and some of them might have lockup provisions or other kind of rules about them, so be mindful of that too. But I mean, definitely alternatives, as long as you do your research and make sure it aligns with your investment philosophy and your goals, then I mean, it might work for you.
It really was wild looking at the gold chart recently.
Yeah.
Like it looks like it's like some kind of AI tech stock or something.
Like would we recommend that to a retiree? Maybe not. At this point, yeah.
Yeah, it's gold is a weird one in the sense that like over the very long term the returns have been pretty paltry.
Yeah.
But it's almost like an insurance policy. Like when you need it, it's been there for you historically.
Yeah.
It really popped off. In any case, let's move things along. We have another question to us coming from Andrew. What's the best way to structure a 20% fixed income allocation? Is it bond ETFs? What role should duration play in all of this?
Bond ETFs would definitely be my answer to that, just because trading individual bonds as a DIY investor, I think can be pretty tough. Bond ETFs give you great exposure to all sorts of fixed income securities all over the world on all parts of the duration and credit quality curves. So having those bond ETFs is a great way to do so. Would I recommend a investor to be timing duration, or even if you're not as familiar or comfortable with the bond market, to be kind of piecing together bond ETFs yourself? Probably not. That's where I would maybe suggest more of an aggregate solution, or maybe two different bond ETFs that kind of can complement each other. I think that would be a great approach, but I don't think I would be recommending investors to be, I don't want to say day trading, swing trading, short corporates and long-term duration bonds. I think that can get a little tricky, and you don't need to be so complicated to build a good, sustainable fixed income sleeve. But like I said, there's great solutions out there that kind of capture multiple bond products into one, like a fund-to-fund or an asset allocator. So that would be, I would recommend is the best way to do it.
Yeah, timing the market notoriously difficult, obviously, in any asset class. Yeah. The other thing too is like retirees want to be kicking back and relaxing, right? They don't necessarily want to be managing their portfolio so closely and stressing out about, duration and bond yields and stuff like that. It's a lot to manage. So maybe less is more, to your point. Let's get to our next question. We have one coming to us from Terry. Isn't having 80% in the stock market risky if you don't know what you're doing?
Yes, definitely. And I will say it could be risky even if you do know what you're doing, right? I think if you don't know what you're doing, that's where you might want to go more toward, like I mentioned with the bonds, a solution that captures multiple products into one for you, like an asset allocation product, because if the market's going to move whether you know what you're doing or not, it comes down to you managing your own portfolio. And if you don't know what you're doing, obviously you're not going to buy some random penny stocks. You want to just buy something that's going to capture the broad market, and that way you have exposure to all kinds of stocks in all kinds of different regions, all kinds of different sectors. You're diversified, and that way you also don't have to worry. You can set it and forget it. Those asset allocation products can do the rebalancing for you as the funds move. And that way, you can not be as stressed and not be as concerned that you don't know what you're doing, because a lot of people that invest don't know what they're doing, and that's where you leave it to the pros, the investment managers. I always use this example. I don't know if I used it the last time I was here, but I wouldn't perform a root canal on myself. I go to my dentist. So if you don't know what to do, maybe that's where you can buy a couple ETFs or buy an asset allocation ETF and let the professionals manage the assets.
Yeah, and when we talk about not knowing what you're doing, it's not just I don't know how to read a balance sheet and pick stocks and stuff like that. It's also, do you know how to manage your emotions as an investor? Do you know how to manage like your timeline and stuff like that? Like there can be other considerations like that you have to appreciate, and that's kind of one of the powers of index investing, right? That it gives you that wide swath of assets and gives you a few less things to think about maybe. But of course, never totally foot off the gas pedal. In any case, let's get to another question. This one is coming to us from Mark. I moved to a 100% equity allocation with about 40% in utilities and infrastructure for income stability and growth. What are the potential pitfalls of this approach?
I think 40% in any one sector or even one region could be, I don't want to say risky, but the potential pitfall is that a large part of your portfolio is reliant on the success of these industries, these companies. So, this is where it comes down to knowing what you're doing, knowing the companies and the sectors that you're investing in, understanding what market movements can shift the performance in these industries. And if there is changes, are you actively managing that? Are you keeping up with what's going on in these industries where you can make those changes if need be? Again, that's where I would recommend more of an approach that is balanced across many sectors. You don't have to worry about it as much. But I will say allocations to those two sectors are great for income and yield, especially for retirees. So I don't think it's as risky or the same as a 40% allocation in technology.
Sure.
But with any sector, 40% is almost half your portfolio. So definitely be cautious about it. And the potential pitfall, just to kind of sum it up, is really that everything kind of moves together. So you want to diversify so that things can have some lower correlation with one another.
All comes back to that free lunch, right?
Yeah.
There you go.
Diversification.
Okay. That's all the time that we have, Veronika. Really appreciate you fielding all those questions and kind of sharing the 80-20 perspective with us for retirees. Again, good food for thought, I think, just to open up people's minds a little bit beyond sort of the typical traditional 60-40 approach. So really appreciate you joining us, and we'll have to have you back again soon.
Awesome, thank you.
And of course, to our audience, we appreciate you tuning in as always. Make sure you check out next week's episode because we have the retirement train rolling once again. We're going to be speaking with DIY investor Henry Ma, who's going to explain why he believes dividend investors, they should leave the RRSP in the dust. Bold claim, but he's got some numbers to back it up, so I'm excited to dig into that with him. That's all the time we have for this edition of the show. From everyone at Inside Investing, thanks again for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.